Education Academy are coming to you live with another topic that hopefully you all will all enjoy. As you know, it's been a lot of craziness in the marketplace. The economy's slowing. People are scared of what's going to happen with their money in the future, and they're trying to figure out where to place it. Basically, Leon and I have been proponents of life insurance. I mean, probably going back to early 2000s, but we revisited it again, and I think it was like 2020, and we saw the power of what you can do inside life insurance. So today we're going to talk a little bit about that. Leon, can you kind of tell them why we chose that topic? Why I do a little bit of housekeeping?
Yeah, so 2021 when we came on and we're like, yo, heads up, the Federal Reserve is about to start raising rates. You want to kind of start moving out of speculative stocks, moving into more stable stocks, and maybe even moving out of the market in general. Maybe putting your money in cash. We just knew it was going to be a rocky road ahead. So we said that the stuff that's most likely going to get crushed was going to be those high flying, non profitable, really highly speculative technology stocks that a lot of us were in, Brent and I included, coming out of COVID. So Brent and I moved out of a lot of that at the time. And as I said, we said, moving things that if you're going to stay in stocks, move to stocks that are not as speculative. One thing we did not mention that Brent has brought up, we were just talking earlier, it's really, really good information, is that is life insurance, right? And the reason being is that so we, one of our biggest things was moving to non-speculative tech, but also to moving things like banks, insurance companies, what have you, because their stocks are going to benefit from rising rates, right? So we were saying move out of things that get hurt by rising rates, like speculative tech, and then things that benefit from rising rates, like banks and insurance. One thing we didn't mention at the time was life insurance. A lot of people don't know that life insurance. So Brent has hit me. So I was actually one of the people back in the day that was like life insurance is a scam. It's they try and get your money. It's crap, right? Yo, when Brent sat down with me and showed me the internal workings of a properly, you were there, properly structured life insurance policy, man. I mean, and I can't. I don't know if it was here. We actually did a live before on ways to guarantee you'll become a millionaire in life. And I believe Brent, correct me if I'm wrong. I think it was we did. Was it life insurance we did on the
No, we
internal?
just looked at the rates of return. It was just basic
Oh, okay,
rates of
okay,
return.
rates of return. Okay. Well, life insurance is one of the things
But you
that
can absolutely become a millionaire in life
yeah,
insurance.
right. Life insurance is one of the things that can almost nothing's guaranteed at all, ever. But life insurance is about as close you can get to becoming a millionaire over time with life insurance because a lot of people that don't know inside of life insurance, there are things like cash value, rates of return, what have you, which again, structured properly. Because a lot of people that say them in the streets are just talking about term life insurance, which is, I mean,
It's term
it's
insurance.
yeah, it serves a purpose, but for long term growth and wealth, it's not the one. So we're going to talk a bit today about how life insurance right now in this environment, rising rate environment, life insurance can be a big and profitable investment over time.
Yeah, and let's start there. We're talking about the two types of life insurance. Um, if anybody notices that I'm a little choppy, I'm away doing a training right now, and the internet is not fantastic. But Leon and I, in our commitment to show up,
Yep.
we're still showing up. So, this Wednesday we want to talk about insurance, life insurance specifically. Many of you all have heard people throw out all types of names for life insurance: variable universal, individual index universal life, high early cash value, accelerated payment, viatical agreements. I mean, you probably have heard all types of names to describe life insurance. There are only two types of life insurance: term life insurance, whole life. That's it. There are a bunch of names like what we mentioned earlier: 20-year term, of course that's term. 30-year term, of course that's term. Mortgage insurance, ha ha ha, that's term. So you hear mortgage insurance. What that is a life insurance. The mortgage insurance I'm talking about is a life insurance policy that's matched to your mortgage, that if anything happens to you, it actually pays off the mortgage company to make sure they get their money. Many of us buy it. It's normally just a check box on our mortgage when we're doing our K1s or when we're completing our paperwork. Oh, HUD one, and we don't even think about it. You just check the box, and you know that's term insurance. It expires normally in 30 years because that's normally going to match most people's 30-year um, mortgages. So then you have the whole life side. You hear people talking about, oh, get an index universal life policy. It's just a whole life policy that's matched to some indice. And then they're like, oh, get a variable universal life insurance policy. It's the best kind. It's just a variable policy that's normally connected to a stock type return, a stock type investment inside of a whole life policy. So instead of being matched to an indice, a variable universal life insurance policy would be matched to mutual fund type investments, which in this day and age is is outdated. I'll put it that way. Then you have IULs, ULs, and all the mix. Early pay, 20 pay cycles, high early cash value. That just means you're putting a lot of money in very early in it. Why does all this matter? Why do we care? Number one, we don't want you to be confused when you talk to other people and they say, well, I don't sell whole life insurance. I sell this kind. Run that little section back and go, oh, wait. Variable universal life is whole life insurance. It's just a type of whole life insurance. You already know they don't know what they're talking about. And if somebody comes in and say, oh, I have a 20-year life insurance policy, or I have a even final expense insurance policies, it's just a really basic type of whole life policy. You're guaranteed to have insurance for. If you're guaranteed to have insurance your whole life, it's a whole life policy. If the insurance only lasts for a certain period of time, it's a term policy. That's it. So why do we care about that in the rising interest rate environment? As interest rates go up, similar to what's happening in banks, it's very small increments that you see increases in the bank products, but you do see increases in bank products. Conversely, you also see mortgage rates going up. You also see the cost for car loans going up. Now, back to the positive side for us, the consumers, when you have a life insurance policy that's done, again, a life insurance policy with a reasonable growth rate inside of it, you're going to get a raise in that interest rate as well, which means the internal rate of return. That's what you want to look for when you look at life insurance, the internal rate of return. That internal rate of return goes up, I would say, significantly faster than what you would see at a bank in your favor. So as you start to invest these monies, especially when you have small children, if you have a child under 10 and you don't have a whole life policy set up on your child, you are doing them a disservice unless you are absolutely strapped for cash and everything you comes into the house is needed for a bill. I get it. We're not here to shame anybody into like everybody has life insurance. But one of the greatest transfers in American history has been done through life insurance policies. You can talk, Leon, I love the stock market, but the facts are more wealth is transferred through life insurance in the United States than any other vehicle. We love entrepreneurship. The fact remains, how many of you all right now today can go out tomorrow and set up a system that guarantees your kids get $2 million, $1 million tomorrow? How many of you all could duplicate that inside of a business? How many of you all could build a business in 1 week that would guarantee your kids inherit $2 million, $1 million, 500? I mean, please comment. I would love to know. If you can structure a business in a week that can do that, that's amazing. You can do that in life insurance. Once you purchase life insurance, you're actually guaranteed to get and approved, you're guaranteed to get that face amount when the time comes when we die. Everybody dies. Now, what Leon was referring to was internal rate of return. Why is that important? Because now we have what's called a living benefit. Well, what happens if I'm alive and I want to use my money, Brent? Leon, you threw this thing out there about life insurance. I don't want to have to die before it becomes sexy. You don't. And that's why Leon said some very important words. When done properly, you can enjoy living benefits. Now, many of the people who set up these, index universal life policy people, I sell those, so not hating. But when the market took a turn for the worse and you were connected to those indices, your premium either went up or the amount of insurance that you were going to receive in case something happened to you went lower. You probably didn't even check your policy. You might not even know it. But those things happen. And if you do have guarantees or riders that locked you in, more than likely the cost of those riders is eating into your return in a way that you don't even understand. Because you can buy what's called a rider and that puts certain locks inside of your insurance policies. They cost money. You can call your agent, ask your agent if you think this is false. Please challenge me. Call your agent, ask if you have any riders on your insurance policies, and ask if there's a cost for the rider. If they tell you it's not, call the company and ask the company. Because call me if it's not. Like, put a comment. I would love to know about it. But riders cost money in general. So the internal rate of return, as interest rates are going up, are you taking advantage of that? Now, right now, I always love talking about small children, but it doesn't have to just be small children. Business owners, if you don't have a supplemental retirement plan, you can actually do that through life insurance. And what that does is set up a whole life insurance policy that allows you to put money into your life insurance in case something happens to you. Your loved ones are paid out. In case you live forever, as long as into those hundreds, all of a sudden, then that means that the money locked up in, you can start pulling it out to kind of offset some of the monies that you thought you might have had in retirement. Maybe business had a couple rough years. Maybe when you went to go sell the business, you didn't have as much in your 401k. Now you have this supplemental retirement plan, which is life insurance, and you can slowly start to receive funds from it. And there are different ways to receive funds from it to help lower your taxable obligation. I was trying to think of a good way to say it that was politically correct. So there are ways to legally structure your life insurance policy to make them absolutely just on fire. And for a lot of you business owners who are doing extremely well, maybe you maxed out your 401ks, you maxed out your 457 plans, and you can't put any more money in. Guess what? You can put money into a life insurance policy. Now, let me warn some of you all. And this speaks to the power of life insurance. Life insurance is so powerful that if you put too much money into it in a way that does not meet government standards, you will create a mech. And that means that your life insurance just moves from life insurance to a modified endowment contract. We're not going to go too far into that, but just know that if it does become a modified endowment contract because you were putting too much money into it, you actually now may owe some taxes on it that you weren't really anticipating. That's not good. You want to speak to not only your financial advisor, you should also speak to your tax advisor if you're looking to overfund your life insurance policies, or if you have a large amount of money that you want to put into it from the beginning. If that's the case, you might want to do what's called a high early cash value policy. And that allows you to stack a whole lot of money into it real fast. Again, I'm going to keep revisiting this theme. If you put a lot of money in very quickly, and it's a high early cash value policy, that means that the interest rate being up works in your favor, even like it's a stronger engine now because you just super infuse a lot of money very early. And everybody knows the golden goose in this world of investing is compounded interest. And so if you are putting, let's say, one person is putting $1,000 a month in, okay, that's going to keep accumulating. You're still going to have an amazing, almost like guaranteed rate of return inside of your life insurance policy. But imagine somebody that can put $100,000 in tomorrow. That means immediately that $100,000 starts to receive the benefits of a higher interest rate because of the environment we're in. So just, have somebody who's not just savvy in one type of insurance. If you talk to somebody and the only thing they do is finalist expense insurance, and they try to convince you that that's just the best insurance in the world, they're doing that because it's the only insurance that they can sell. If you meet somebody who's like, oh, you absolutely have to have a traditional whole life policies. Again, I sell those too. Ask some questions because maybe you should have an index universal life policy, depending on your portfolio and how you're going to be funding it. And for some of you all who need flexible premiums, you might want to look at the variable universal life policy because you have more money than the average person in certain years. Your business is seasonal. And maybe in certain seasons you have a lot, in other seasons you don't. So you want to be able to have flexible premiums. There's a lot of different ways to customize life insurance to exactly what your needs are. But the bottom line is this. It's the one thing that I can think of that's guaranteed to give you a rate of return that far exceeds what you put into it. I mean, there's some insurance policies that are term policies. You could put $500 in and get insured for $5 million. What game of chance have you ever seen where you can put $500 on the table and walk out the door, and if something happens to you, your family's getting $5 million. And for these kids policies, I mean, I've made a lot of kids millionaires guaranteed when they hit their retirement age. So it doesn't really matter what happens at work. If they pursue their entrepreneurial endeavors, and as entrepreneurs know, there's no 401k when we first start. And sometimes it's not a 401k for a lot of years.
Right.
So imagine the freedom that your children will have if they know they're sitting on $1 million or more inside of a near guaranteed life insurance policy that is cash available. So now they can pursue their dreams a little differently. Their stress levels aren't the same as those people who hit their 50s and they're like, oh my gosh, retirement is very real. I don't have enough money. And now they're like, what do I do? I'm not going to receive money from anywhere else. Or the person who lost a parent and realized their parent didn't leave them anything. And they're just here now. And all of a sudden they think, oh my gosh, I have kids and I don't have enough. Life insurance is amazing. You can actually fill those holes, those voids with not only the cash that we're talking about that accumulates, but if you die, there's a face amount that pays out to your family or your heirs in a pretty significant way. So Leon and I just want to remind you, I think it's about time, probably, Leon, for us to revisit and do a case study inside of the platform, the IAA platform, and show not only life insurance for kids, because life insurance for kids, number one, is guaranteed issue as long as there's no real issues at birth. If you have a child and they are under 5, you absolutely, and you can afford it, you should absolutely have it. If you have a child under 10, you should give strong consideration to it. If you have kids under 21, you should start talking to them about them getting their own. Because again, everybody's guaranteed to die. The question is, what's transferring besides stress and debt when you die? And for all you all who are in these 6-bedroom houses, sitting on 2 acres, thinking, oh, they're going to get the house. How much mortgage is left on that house? You didn't leave them an asset that you thought. You left them debt.
And also, as we saw with the great financial crisis in 2008, the price of the house can go down. So yeah, it's ultimately, yes, a home is a great thing to leave your kid, but it's not enough. Like we say, nothing is guaranteed. The internal rate of return of life insurance and the death benefits, and then the cash rate that grows over time in life insurance, man, it is one. And like Brent said, it's one of the most powerful wealth generators that, I guess, quote unquote, the average person doesn't know about, that doesn't take advantage of. And like Brent said, I believe it was during COVID, the largest wealth transfer ever happened through life insurance, because a lot of people that sadly died from COVID were older people in in old folks' homes. So a lot of those people had relatively wealthy and had life insurance they passed on to the kids. And I can't even say relatively wealthy. You don't have to be wealthy for this. You just have to be able to pay your premium, so that over the life of your life insurance policy, you build up that cash value, which again guaranteed as well as your death benefit is guaranteed. So as long as you pay your premium. So the moral of the story here is that as interest rates have gone up and will continue to go up probably over the next month or two, life insurance, the internal rate of return of life insurance also has gone up. So that's another asset that we want to look at investing in over the long term to get a return on our money. And I just looked it up real quick. The rates of return right now it's a wide range. The rate of returns right now for life insurance between whole and life, and I mean Brent can break down all the differences, but between the two is anywhere from 1.5 to upwards of 8%. So I mean it's a huge range, but again, it's all how it's structured. It had your certain your suitability, your health and everything like that. But that's even 1.5% is way above what you're getting in your traditional bank of point right now. The average return, even with rates have gone up 5% in a year and a half, 5% from 0 to about 5% now. Banks are still only paying an average of 0.37%. 0.37%. Now that is up from 0.05% before they started raising rates. So we've seen some benefit, but the average rate of return right now in a savings account in the United States is 0.37%. Again, the low end for an insurance policy is 1.5%. It can go all the way up to 8%. So it's something else. It's something else to look at.
Yep, and also too, there's ways to even break the 8% mark. Those are averages that Leon is looking at. But they're even with the writers cost money, but some of those writers are worth it. So it's not to say writers are just bad, but you should know how they work and how they should be placed in the proper structure for you.
Are you saying writers or
No, riders, like a rider in your
Like
car.
ride a bike?
Yeah.
Riders. Okay.
Yeah. And those are things that just ride along with your insurance policy as you have it. So just to give you an example, a rider may, and this happened when I was new in the business. This is what got me hooked on life insurance, honestly, everybody. So I came out of school 2001, Bowie State University, stand up. So when I came out of BSU, I was a banking finance major, and Leon and I already had our company back then. It was called Wealth Enterprise. And because of Wealth Enterprise, I was very attractive to businesses in the financial sector. So I had no problems getting a job. Between my degree and the fact that I already started a finance company with Leon back then, there was a lot of offers. So I decided to go with Chevy Chase Financial Services, which was a division of Chevy Chase Bank way back when, 2002, 2001. They threw us in the pit, and in the pit, you were cutting your teeth. Is where brokers, you had to sit in the pit. You took stock orders by hand from people who called in on a recorded line, and you had to write down the number of shares, write down the share price, write down the QSIP code, write down the ticker symbol. I mean, I'm reminiscing right now. Okay, so bottom line is this will happen. Phone rings one day. Turns out one of the agents sold a life insurance policy to somebody who had died. The person died, I think it was 10 days after they had written the life insurance policy for the person. And they had only taken one premium. And because of that one premium that they took, and they didn't even finish underwriting. Like it wasn't even like done underwriting. Like the whole process to get it started wasn't done. But because the agent took the check, the person signed off, it was considered insured. They got a payout of $3 million
for one premium payment.
For one premium payment. This person, I think, paid, I think it was $600 some dollars. It was an older person. It was like $600 some dollars for 1 month. $3 million. I was like, goodness gracious. So I started looking around our community, and people were like, oh, I'm insured at work. If I heard that one more time, I was like, because as we learned in COVID, most of these people were being fired or the job was downsizing, and then they died. And all these benefits that they thought, or they retired early, and they realized, oh, in retirement, I don't get to take this with me. No, it was a group benefit that had to stay with the company. Example number two, I'm a more seasoned agent at this point. I'm probably 5 years in with a different firm. They do a roundtable discussion, and they were doing a real case study from one of the clients of the firm. This person had a writer. We talked about writers, right? And so this was a real life example. Their writer was called paid up addition, waiver of premium. It was a waiver of premium. And the waiver of premium, the way it worked at this particular company is that if a person were disabled for any reason, and this company's definition of disabled was cannot do the functions of the primary job, they would then have their premium paid by the company and never have to pay the premium themselves for as long as they were disabled. Apparently, they had a person who had been on taking advantage of this waiver for like 20 years. And inside their policy, they probably made 2 years worth of premium payments. It was a very long time ago, so just these numbers aren't exact. Let's just say, for example's sake, it was $2,000 that they paid into this life insurance policy. Then they got disabled, and the life insurance policy kept paying. The company paid the premiums for them because they paid for the rider. They ended up having, was it $1.4 million in cash inside this policy that they had access to. Like they had, it was their money. And they had
all they paid in from out of their pocket was
like 2 years, like $2,000.
About $2,000, right?
And so you think the waiver premium, the people are like, well, I'll never be disabled. Most people under the age of 50 are more likely to be disabled than they are to die. And I could totally geek out on the numbers, but this isn't for this particular live. But bottom line is, many of you all think, well, I have it at work. I don't need it. My kids won't know what to do with the money. I never had it. Those are just bogus reasons to not have life insurance. Unless you just want your kids to suffer, which some people do. I don't get it. More power to you. I'm not your parent. But if my kids know if something goes down with my wife and I, they get 2.4 million. If they have their own life insurance that we purchased for them, and no, that does not mean that we wish they would die. No, that does not mean that some voodoo is on them now and they're going to die early. It's a responsible thing to do as a parent. Getting life insurance, it doesn't jinx your kid. And so we got life insurance on them. If they continue throughout their life and they get to retirement, they're both sitting on $500,000 in cash. And so we'll probably put in about 23,000. And so these are things.
Real quick, you're paying about 20,000 over the life of the policy.
Over the life of the policy.
But in the end, they're going to get upwards of $500,000.
And when they hit retirement age, they're both sitting on a little over $500,000
in cash value.
Cash value.
And then the payout, but the payout is also separate money.
Yeah. So if let's say they don't need the money at all, right? They do very well with their businesses and their stock accounts as they invest, and they have businesses. So let's say everything goes well. Also, too, for most kids, man, I'm about to go full geek.
Yes.
I think the stat is at the age of 7, you can put them on your payroll, and if you can pay them a salary of somewhere like $6,000 for an 8-year period or something, and it's invested in the market with average rates of return, they're guaranteed to become millionaires inside of their investment account from you setting up a Roth IRA for them because they're on payroll, right? So now they have earned income. They can set up a retirement account. How many of us had a retirement account set up at age 7?
Mm-hmm. Right.
Age 9, 10, whatever.
And real quick, these are things that other communities do, right? And I'll say other, I mean non-Black, non-POC, non-immigrant communities. These are normal conversations, right? But and as Brent's saying, setting up a life insurance policy or retirement policy for your kid at 7 years old, these are conversations we never have. And I would challenge anybody in the comments to tell me that you've had a conversation with your kid, or you had a conversation about a retirement account, life insurance, what have you. We just don't do it. So that's what we're trying to, kind of keep people in the butt now and say, hey, we need to start having these conversations in our community so we can take care of our kids and our kids can, go on to prosper later in life.
Yeah, and please stop doing the whole "this is grown folks' business" piece because your parents said it to you.
Right.
Like it's just passing down some horrible habits. If we talk to our kids, I've talked to my kids. If you get $2.4 million, what do? You invest it and try to get 10% rate of return. You put some into a guaranteed policy because at that point you don't really need the money. They know these things, and they both know they're supposed to take $500,000 and use that to buy a life insurance policy. Well, it wasn't 500. The thing was 50,000 and buy a life insurance policy. If they did 50,000 into a high early cash value policy, they say they're in their teens or 20s or 30s, they probably can get a policy for about $10 million. So, or $5 million, $5 to $10 million. So now that means that they get to leave $5 to $10 million to my grandkids when they die, and they should have had the conversation.
And also inside that, there's a rate of return they're earning. There's actually money there they can access now, and or leave when they die as well.
Yeah, and then if I raise them well, they will talk to their kids if they choose to have kids, and tell them that their responsibilities to our family, our legacy, is to buy a $10 to $20 million policy. And some of you all out there are just going to be ignoring these conversations because you think your kids are spoiled or whatever it might be. And they're going to be hurting pretty bad because as this world goes on, money's going to rule. Mm-hmm. And it's just the capitalistic society in which we live. As resources get short, people who can't afford them are going to hurt the most.
And let's like Brent said, let's stop with the whole thing about this grown folk business. So we can't talk to our kids about money or about death. That's wrong. That's hurting ourselves. And 2, which I've seen, all of us, I know Brent and I have seen it. People put all their weight and even some of their retirement into crypto. Let's kind of get away from that, right? Because people were like, "Oh, crypto is another asset class." We've talked about it ad nauseum. It's basically like tech. It's going to follow tech. It's a speculative, high risk asset. So let's get away from, hey, I'm gonna put all my money in crypto. And it's gonna go to $3 million in 10 years. That may happen if you have money into it, great. but we shouldn't mortgage our kids' future on that, right? Let's put in things we actually know work. Things like the stock market that pay dividends, the companies that have profits, also things like real estate, yes, things like life insurance that have a rate of return, a guaranteed rate of return, as well as a death benefit. So we just got to do better. That's what we're trying to. That's why we're trying to have these conversations with the IEA community and anybody else out there who's listening. There are better ways to get a return on your money than just speculating on high risk things. High risk, high reward is true, but high risk, high reward. If you ask most people that play those games, the risk and the loss is higher than the reward. And I've done it. Brent's done it. We did that a couple years ago. We've learned our lesson. That's why we're a lot more conservative now where we put our money, because we've cut our teeth on a lot of these. We've made a lot of mistakes. So we're trying to get everyone ahead of these mistakes now.
And your kids have the luxury of time.
Oh my gosh.
And that's why I'm like, man, if I would have known this, like if my mom would have guaranteed I had $500,000 sitting waiting for me, that would be life changing. I mean, just even from a stress standpoint. So it's not even about the money, just that you don't even know the stress that you ignore when you have a safety net. Like if you jumped out of a plane and you didn't have a parachute, you freak out, right? If you jumped out of a plane, you had a parachute and you know how to pull it, it's not so bad.
Right.
So, it's just think about this, people. Our kids, us, the highly wealthy, something might happen. If you're uber wealthy, this is not that you should ignore this. You can get a high early cash value, and that means that the raising interest rates will start working even faster for your money. And there's ways to legally make it so the tax impact is very small. So I'll just put it that way. So with that being said,
and what I say is we always, there's a famous saying that Brent and I repeat all the time. We didn't come up with it, but it's a important saying. Don't want to take somebody's credit. It's not about timing the market. It's about time in the market. Same thing with real estate. Same thing with life insurance. As Brent just said, if you start your kids earlier, I mean, Brent started his kids, I don't know, 7, 8, 9 years old, had their own policies.
Nah, man, 3 and 4.
All right. So his kids are going to have life insurance policies for, God willing, they live till be 150 for the next, 100 plus years, right? I mean, how much money they're going to have that passive income. They're just, all they're doing is paying a premium, not working for it.
Oh, and I'm dying. And dude, we only pay the premium beyond 15 years.
Right. Oh, yeah, that's true. Yeah. After 15 years, the premium stops, but the cash value is still going to grow. So his kids are going to have passive income to whenever they die, and or whenever they need that money, they can borrow against it. They can do different things with it. So again, moral of the story is rising interest rates environment that helps an asset like life insurance. So something else you want to look into.
Yep. Everybody, we owe you 2 stock picks. So please log into the IEA portfolio, the IEA members platform. And, once you log in, you know where to go. Check out stock picks. And for you all who are still trying to figure out, should I be a member? Do you want your money to grow? And if it's not with us, you should be in some community where people are educated on finance, not just part of a pyramid scheme, or they just got some fake license 2 days ago. Leon and I have been doing it since we were 16. And if you do want to see our credentials, they include a Series 6, a 7, 63, 65, corporate registered investment advisory work, CEOs of tech companies, fintech startup, ed tech startups. I mean, you name it. we
got it covered.
Yeah, we got some pretty sick resume if we throw it out there. So we don't care if it's us. Just make sure wherever you go, it's a quality group and they're providing good information. We will give you our 2 stock picks, and we look forward to talking to you again in 2 weeks. Oh man, we should start doing that thing they used to do, 2 and 2.
What 2 and 2? Who was that? Was that Donnie Simpson? I think it was 2 and 2.
I don't know. Hey, if you know who did the 2 and 2, shoot us, put it in the comments and let us know who it was.
I think it was
Donnie. All right, everybody.
2 and 2. 2 weeks.